We are here to uncover the truth behind financial myths and share valuable insights to help you build wealth and secure your financial future. In today's video, we're going to expose one of the biggest lies told by banks and reveal 6 alternative assets that can protect your wealth from deterioration. Have you ever wondered if your money truly grows in your bank accounts? The reality is quite different from what we've been led to believe. While banks emphasize the growth potential through interest rates, the value of your money may not increase in real terms. With inflation soaring through the roof and bank interest rates slowly behind, keeping your cash in the bank could be a terrible idea. If you're tired of your hard-earned money sitting idle, vulnerable to inflation's grasp, then you're in the right place. Join us as we explore alternative avenues that can protect and grow your wealth, providing you with a brighter financial future. Let's dive in. Number 1 is precious metals such as gold, silver, or platinum. One of the primary reasons why money holds value is because it is used as a store of wealth for the future. However, in today's world, governments continuously print more money to finance their deficits, leading to the devaluation of currency. This is why financial experts recommend investing in valuable assets that are scarce and cannot be easily created. Precious metals such as gold, silver, and platinum have long been recognized as stores of value. They tend to rise in value when inflation is high and are often seen as a hedge against economic uncertainty. For instance, the price of gold has significantly increased over the years. In 1950, an ounce of gold could be bought for $400, while in 2023, the same ounce is priced above $2,000. According to Prime XBT's gold forecasts, the price of gold is projected to reach $10,000 by 2032. This means that in approximately 10 years, your gold investments could be worth 5 times their current value. Therefore, while cash may lose its value over time, precious metals like gold have the potential to appreciate in value. Other precious metals such as silver and platinum also have similar characteristics, making them attractive alternatives to holding cash in the bank. If you are interested in gaining exposure to gold without purchasing physical gold, you can consider investing in gold ETFs, that is, exchange-traded funds. Gold ETFs are highly affordable investment vehicles that provide returns based on the movements in the price of gold. They offer an opportunity to participate in potential appreciation of gold without the need to physically hold the metal. Number 2 are industrial commodities. While scarcity is one of the reasons why precious metals are considered valuable, industrial commodities have their own utility value, making them indispensable in various industries. For instance, silver is used in the production of electronics, medical equipment, and nuclear reactors. Similarly, other metals such as cobalt, nickel, and copper have high industrial demand due to their unique properties that cannot be easily replicated by alternative materials. Investing in industrial commodities can be lucrative during high demand phases. For example, the demand for cobalt has skyrocketed since 2020, mainly due to its crucial role in producing batteries for electric vehicles. Consequently, the price of cobalt has risen from $20,000 per ton in 2012 to $40,000 in 2022, representing a 100% increase in just 10 years. However, not everyone has the means to invest large sums of money in acquiring raw materials, nor can they physically store or find buyers for these commodities. In such cases, investing in stocks of mining companies, mining-focused mutual funds, or derivatives such as futures and options can provide exposure to these commodities and potentially boost your investment portfolio during high-demand phases. Number 3 are safe haven currencies. In the current world of fiat currencies, where no currency is backed by gold, geopolitical stability becomes a crucial factor when considering where to invest your money. This is why wealthy individuals often choose to keep their money in Swiss banks. Switzerland, known for having one of the world's strongest economic systems, offers a much more stable geopolitical environment. As a result, the Swiss franc is considered a safe haven asset during times of turmoil and instability. We have seen this phenomenon occur time and time again. For instance, during the Eurozone debt crisis in 2009 and the global financial crisis in 2008, sizable funds flowed from affected countries to Switzerland to prevent wealth erosion due to currency depreciation. Additionally, The Swiss franc serves as a valuable alternative to the US dollar for international trade. For example, during the recent Russia-Ukraine crisis, when the US imposed sanctions on Russian energy trade, Russia executed trades in Swiss francs. Such events increased the demand for the Swiss franc, leading to its significant appreciation against all other currencies. In early 2023, one Swiss franc fetched 1.1074 US dollars, multiplying the wealth of Swiss franc holders overnight. Therefore, currencies from countries with superior economic stability and geopolitical environments, such as the Swiss franc, British pound, and Chinese yuan, are considered great stores of value. However, opening Swiss bank accounts or gaining direct exposure to these currencies may not be feasible for everyone. In such cases, currency ETFs and forex brokers such as Forex.com offer opportunities for smaller investors to gain currency exposure with as little as $100. Number 4 is sovereign guarantee. If you closely examine a dollar bill, you will find the words, "This note is legal tender for all debts, public and private." Ever wondered what it means? Since 1971, when President Nixon abolished the gold standard, the dollar has become the legal tender by US law. This has given it value as a medium of exchange, and we have to consider it as an acceptable form of repayment for any goods or services. Although no fiat currency in the world is backed by gold or any other physical asset, they are still considered to be backed by the full faith and credit of the government. In simple terms, the stability of your money is dependent on the stability of the government that backs it. This is why investing in sovereign guarantees can be a valuable store of value. Governments are typically the last entities to default, as allowing a government to default would have significant consequences for the entire nation. Therefore, investing in stable government securities or GSECs can provide exposure to sovereign guarantees. However, it is important to consider the global strength of a government before investing in its securities. Only stable government GSECs with investment-grade credit ratings are advisable. The 2009 sovereign debt crisis in Greece serves as a reminder of the importance of assessing a government's global strength before investing in its securities. During that crisis, the International Monetary Fund or IMF, Eurogroup, and European Central Bank or ECB had to bail out Greece multiple times to prevent a default. In the United States, investors can invest in treasury bills, notes, and bonds to gain exposure to sovereign guarantees. These investments offer better returns than keeping money in the bank and are backed by the US government's strength in the global economy. Small investors can buy treasury securities directly from the government through the Treasury Direct portal or from the secondary market. Number 5 are value stocks and mutual funds. While treasury investments provide better returns than cash, they still offer lower returns compared to stocks. Higher returns are sought by almost all investors, although low risk remains an important criterion for risk-averse investors. Stocks offer a great opportunity to achieve higher returns, but not all stocks are equally risky. The stock market can be broadly divided into two types of stocks: value stocks and growth stocks. Growth stocks, such as technology stocks, are riskier because they deal in ideas and technologies that have a high failure potential. On the other hand, value stocks, such as companies that deal in industrial metals, are considered less risky due to their established demand for the foreseeable future. Value stocks with strong fundamentals not only provide steady and stable price appreciation, but also offer stable dividends. However, researching the fundamentals of each and every value stock can become time-consuming and cumbersome for average investors. Therefore, dividend-focused mutual funds can be ideal and affordable investment vehicles for retail investors. For example, the Vanguard High Dividend Yield Index Fund Admiral Shares, which has a stable history of paying dividends, can provide exposure to a portfolio of value stocks. Number 6 is land and real estate. Land and real estate have been recognized as value assets throughout history due to their scarcity and constant demand. We need land for various purposes such as homes, schools, factories, agriculture, and commercial spaces. With the growing human population, the demand for land will never decrease. Similarly, residential homes, office spaces, and commercial properties built on land are always in demand. Investing in land and real estate can act as an excellent hedge against inflation. According to a Bloomberg study, housing prices have tripled between 1992 and 2020, despite a significant dip during the 2008 housing bubble. However, many small investors tend to think of a real estate as an investment later in life, primarily considering their own residential property. While owning a fully paid up home is a net worth goal for when you reach your 40s, having exposure to the retail property market is recommended at every age. Contrary to common belief, you don't need a lot of money to gain real estate exposure. One option is to invest in real estate investment trusts, or REITs, which are similar to mutual funds but focused on real estate assets. For example, Ventas Inc. is one of the most popular REITs in the US, investing in healthcare real estate including senior housing, research facilities, and hospitals. Another option is to borrow to own rental properties, where rental income covers expenses and mortgage payments while also generating profits. Number 7 are collectibles. Collectibles such as vintage cars, rare art pieces, luxury handbags, limited edition watches, and iconic books fall into this asset class. While some may argue that these items are not traditional investments, they can hold significant value and appreciate over time. For example, vintage cars or rare art pieces can increase in value due to their uniqueness and desirability among collectors. Investing in collectibles requires knowledge, research, and an understanding of the market to identify items with potential value appreciation. It is important to carefully consider each asset class, do thorough research, and consult with financial advisors to make informed investment decisions based on your risk tolerance, financial goals, and time horizon. By exploring these alternative assets, you can mitigate the risks associated with inflation and potentially build long-term wealth. Don't forget to hit that subscribe button and click the notification bell so you never miss an episode that could change your financial perspective.